Welcome back to Bonnie's Life, where we cut through the noise and get straight to the facts. Today, we are diving deep into the current state of the cryptocurrency market. If you have been watching the charts lately, you know things have been wild. We are seeing massive liquidations, extreme fear, and a tug of war between the bulls and the bears. But what does this all mean for you? Whether you are a short-term scalper, a mid-term swing trader, or a long-term holder, this episode is designed to give you the exact blueprint on how to navigate these turbulent waters. We are going to look at the hard data from CoinGecko and CoinGlass, analyze the technicals, and break down the global events that are pulling the strings behind the scenes. So grab your notebook because class is in session. Let us start by identifying exactly what type of market we are trading in right now. To put it bluntly, we are in a high volatility, fear-driven correction phase within a broader macro environment that is incredibly tense. The total cryptocurrency market capitalization currently sits at $2.5 trillion, which is down over 13% year over year, though we have seen a slight 2.4% bump in the last 24 hours. The 24-hour trading volume is hovering around $110 billion, indicating that while prices are suppressed, the market is highly active. Bitcoin dominance remains strong at 56.6%, with its price fluctuating wildly between $67,500 and $71,200. Ethereum is holding at around $2,068, representing 10.4% of the market. This is not a quiet, sideways market. This is a market where leveraged traders are getting chopped to pieces. The sentiment right now is bleeding red. The crypto fear and greed index has plummeted to a reading of 8 to 10, which is the definition of extreme fear. Just a week ago, we were at 16, which was already fearful. But this recent drop shows that retail and institutional panic is setting in. When the market is this fearful, it usually means one of two things. Either we are approaching a capitulation bottom where the smart money starts accumulating, or we are on the precipice of a deeper structural breakdown. Given the current data, the market is heavily skewed toward the latter, with traders pricing in worst-case scenarios across the board. Let us dive a little deeper into the psychology of the market right now, because understanding the human element is just as important as reading the charts. When the fear and greed index hits 8 as it has recently, we are not just looking at a number on a screen, we are looking at raw, unfiltered human emotion. This level of extreme fear is characterized by panic selling, where retail investors who bought the top are finally throwing in the towel. They watch their portfolios bleed day after day, and the psychological pain becomes too much to bear. This is exactly the environment where institutional players and seasoned whales step in. They do not buy when the market is euphoric and everyone is making money. They buy when there is blood in the streets. As a trader, you have to train your mind to detach from the panic. When you see a $400 million liquidation week, your first thought should not be fear. It should be, where is the opportunity? Let us look at the derivatives data, because that is where the real story is told. According to CoinGlass, Bitcoin open interest has stabilized at roughly $16.9 billion. However, the fascinating part is how this open interest behaved during the recent price drops. As Bitcoin fell towards $68,750, open interest actually rose. This tells us that short sellers were aggressively adding to their positions into the weakness. But when the price rebounded near $69,700, open interest barely changed, indicating a severe lack of conviction from the bulls. The market is currently top-heavy with leverage, and the recent price action has been a masterclass in pain for those caught on the wrong side of the trade. Speaking of pain, the liquidation data is staggering. In a recent trading session, we saw over $400 million in crypto liquidations, with a massive 85% of that being long positions. In just a 24-hour window, $272 million in contracts were wiped out. Bitcoin long liquidations accounted for $126 million, while shorts only lost $11.7 million. Ethereum longs were also hammered, losing $88.5 million. What this tells us is that retail traders keep trying to catch the falling knife, buying the dip with leverage, only to get flushed out by sudden downside weeks. This is a classic hallmark of a market that is searching for a bottom, but hasn't found the necessary support to sustain a reversal. Now, let us zoom out and look at the global macroeconomic events that are dictating this price action. You cannot trade crypto in a vacuum. It is deeply tied to global liquidity and geopolitical stability. Right now, the biggest dark cloud hanging over the market is the escalating US-Iran conflict. The threat of strikes on Iranian power plants has sent oil prices surging, which in turn stokes the fires of inflation. When inflation expectations rise, the market prices out the possibility of interest rate cuts. The Federal Reserve recently held rates steady at 3.50% to 3.75%, and the swaps market is currently signaling zero chance of rate cuts in 2026. This is a massive headwind for risk assets like Bitcoin. Adding fuel to the fire are the new tariff announcements from the Trump administration, which are pressuring global equities and tightening liquidity. We are also seeing structural shifts in the crypto space itself. Last week, Bitcoin spot ETFs saw $177 million in outflows, breaking a massive $2 billion inflow streak, while institutions like MicroStrategy are still accumulating, adding another $76.6 million in BTC last week to bring their total to 761,068 Bitcoin. The broader institutional appetite has temporarily cooled. Furthermore, South Korea, a major hub for crypto trading, has seen its crypto liquidity tumble, with stablecoin balances plunging 55%. All these factors combine to create a macro environment that is hostile to sustained bullish momentum. Furthermore, we need to address the concept of market cycles and where we currently stand within the broader historical context. If we look back at previous Bitcoin cycles, we often see these mid-cycle corrections that shake out the weak hands before the next major leg up. The drop from the $126,000 all-time high down to the current $70,000 range represents a significant retracement, but it is not unprecedented in the volatile world of cryptocurrency. What makes this particular correction unique is the confluence of macroeconomic factors weighing it down. In previous cycles, we had the benefit of quantitative easing and a zero interest rate environment. Today, we are fighting against sticky inflation, geopolitical wars, and a Federal Reserve that is hesitant to cut rates. This means the recovery phase may be slower and more arduous than what we experienced in 2020 or 2021. Let us transition into the technical analysis, starting with the long-term view. For our long-term investors, the weekly and monthly charts are flashing some concerning signals. Bitcoin's all-time high was $126,000 back in October 2025. Since then, we have seen a series of lower highs and lower lows. The most critical indicator right now is the MACD histogram on the daily chart, which has just crossed below zero for the third time since the peak. Historically, since October, every bearish MACD cross has preceded a steep sell-off. For instance, on November 3rd, a bearish cross led to a drop from $106,000 to $80,000. On January 20th, another cross led to a decline from $90,000 to $60,000. The indicator is flashing red again, suggesting that the current resilience around $70,000 may soon crumble. On the moving averages front, we are seeing a classic battle at key levels. The 50-day simple moving average currently stands at $77,200, acting as a heavy dynamic resistance. The 200-day SMA is way up at $96,800. More importantly, the 50-day has crossed below the 200-day, forming a death cross, which is a traditional bear market signal. However, Bitcoin is currently testing its 200-week exponential moving average as support. If we see a weekly close below this 200-week EMA, it would signal a structural breakdown that could send prices tumbling toward the low $50,000. The Bollinger Bands are also squeezing tightly, which is a precursor to a massive explosive move in volatility. For the mid-term swing traders, the daily and 4-hour charts provide our battleground. The RSI on the daily chart is sitting at 46.15, which is technically neutral but leaning bearish. It shows that while we aren't deeply oversold yet, the momentum is certainly not with the buyers. The key support levels to watch are $68,000 and the psychological barrier at $65,000. CoinGlass data shows that there are over $3 billion in leveraged long positions sitting just below $65,000. If the price drops to that level, we will see a cascading liquidation event that could cause a violent flash crash. On the upside, resistance is fierce at $71,200 and $75,000. Any rally into these zones should be viewed with extreme caution unless accompanied by a massive spike in spot buying volume. Now, let us talk about the short-term scalpers and day traders. In a market this volatile, your edge comes from exploiting the inefficiencies caused by liquidations and news-driven weeks. The 15-minute and 1-hour charts are dominated by algorithmic trading and stop hunts. We are seeing a pattern where the price slowly grinds up enticing late longs, only to violently wipe them out with a sudden $2,000 drop. For short-term traders, the strategy here is not to predict the trend, but to react to the extremes. You want to be looking for overextensions in the funding rates and open interest. When you see open interest spiking while the price is stagnant, a big move is imminent. Another critical factor to monitor is the behavior of the miners. Bitcoin miners are the backbone of the network, and their profitability directly impacts the market supply dynamics. With the price hovering around $70,000, many miners are operating on thin margins, especially those with older, less efficient hardware. If the price drops significantly below $65,000, we could see a wave of miner capitulation. This happens when miners are forced to sell their Bitcoin reserves just to cover their operational costs, adding immense sell pressure to an already fragile market. You can track this by looking at the hash ribbon indicator and miner outflow metrics. A spike in miner outflows often precedes a short-term price drop, so keeping an eye on this data provides an extra layer of confluence for your trading decisions. Let us also discuss the role of stablecoins in the current market structure. The total stablecoin market cap is currently around $312 billion, representing roughly 12.47% of the total crypto market. This is a massive amount of dry powder sitting on the sidelines. When investors sell their crypto assets, they typically move into stablecoins like USDT or USDC rather than cashing out to fiat currency entirely. This high stablecoin dominance is actually a hidden bullish signal. It means the capital hasn't left the crypto ecosystem, it is just waiting for the right moment to re-enter. When the macro clouds begin to part and the technical indicators flip bullish, that $312 billion will act as rocket fuel, propelling the market upward. As a trader, you should monitor stablecoin inflows to major exchanges. A sudden influx of USDT to Binance or Coinbase is often the precursor to a major buying spree. So, how do we actually trade this market? Let us break down the specific strategies for each time frame, starting with the short-term traders. If you are day trading, your primary focus should be on capital preservation and trading the ranges. The current range is roughly $67,500 to $71,200. You should be looking to short the local tops near $71,000, placing tight stop losses just above the recent weeks. Conversely, you can look for quick scalp longs near $68,000, but you must be quick to take profits. Do not hold positions overnight as the geopolitical news cycle is too unpredictable. A single headline about the Middle East conflict can gap the market $3,000 in either direction while you sleep. Use the liquidation heat maps on CoinGlass to see where the stops are clustered and trade in the direction of the liquidity sweeps. For the mid-term swing traders, patience is your greatest asset right now. The market is in a no-trade zone for directional swing trades until we get a clear resolution of the current consolidation. Your trigger for a short position would be a confirmed daily close below $68,000, targeting the $65,000 liquidity pool and potentially lower to $60,000 if the liquidations cascade. Your trigger for a long position would be a daily close above the 50-day SMA at $77,200, which would invalidate the immediate bearish structure. Until one of those triggers hits, the best midterm strategy is to stay in cash or stablecoins and let the market show its hand. Do not try to front-run the breakout. Wait for confirmation and trade the follow-through. For the long-term investors and spot accumulators, this extreme fear is exactly what you have been waiting for. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. With the fear and greed index at 8, we are in the zone of maximum pessimism. However, because the macro environment is so hostile, you should not be deploying all your capital at once. The strategy here is aggressive dollar cost averaging, DCA, into high conviction assets like Bitcoin and Ethereum. Set limit orders at key psychological levels, $65,000, $60,000, and $55,000. If the market flushes down to those levels, your orders will fill at a massive discount. Remember, the 200-week EMA is currently holding. If it breaks, that is your signal to buy the blood. Let us not forget about the altcoins. While Bitcoin is fighting for its life, the altcoin market is bleeding heavily. Solana is currently battling heavy resistance at $90, with its price hovering around $94. XRP has fallen 13% in a week, trading around $1.46 despite recent ETF inflows. BNB is sitting at $627. In a market environment like this, where Bitcoin dominance is high at 56.6% and liquidity is tightening, altcoins will underperform. If Bitcoin sneezes, the altcoins catch a cold. For short and mid-term traders, I highly recommend avoiding altcoin exposure right now unless you are specifically shorting the weakest performers. For long-term investors, wait for Bitcoin to find a definitive bottom before rotating capital into altcoins. Let us also take a closer look at the altcoin ecosystem because there are nuances here that require careful attention. While I mentioned earlier that altcoins are generally underperforming, there are always outliers and specific narratives that can buck the trend. For instance, the decentralized finance or DeFi sector and the artificial intelligence-related tokens often show independent strength during certain phases of the market. However, right now, the liquidity is simply not there to support a broad-based alt season. When Bitcoin dominance is climbing and currently sitting at 56.6%, it means capital is fleeing the riskier altcoins and seeking the relative safety of Bitcoin. Until we see Bitcoin establish a firm, unbreakable bottom and begin a slow, steady ascent, the altcoin market will remain a dangerous place for swing traders. If you must trade altcoins, focus on the top 10 by market capitalization, like Ethereum or Solana, and avoid the low-cap micro-gems that can easily drop another 50% in a single day. Finally, I want to leave you with a thought on risk management. Because in a market this volatile, survival is your primary objective. It does not matter how good your technical analysis is or how accurately you predict the macro trends if you do not manage your risk properly. Never risk more than 1% to 2% of your total trading capital on a single trade. Use strict stop losses and do not move them just because you hope the market will turn around. Hope is not a trading strategy. If you get stopped out, take the loss, step back, and re-evaluate the market with a clear head. The market will always be here tomorrow, offering new opportunities. Your job is to make sure you still have capital left to seize them. Stay disciplined, stay objective, and let the data guide your decisions. In conclusion, the current crypto market is a treacherous landscape dominated by extreme fear, heavy liquidations, and hostile macroeconomic headwinds. The technicals are flashing warning signs, with the MACD turning bearish and a death cross on the daily chart. The US-Iran conflict, sticky inflation, and the lack of Fed rate cuts are keeping a lid on any sustained bullish momentum. However, within this chaos lies incredible opportunity. Short-term traders can feast on the volatility, mid-term traders can wait for the inevitable structural break, and long-term investors can accumulate at generational discounts. The key is to know your time frame, stick to your strategy, and never let emotion dictate your trades. That is all for today's deep dive into the crypto markets. Remember, the data does not lie, but the market can remain irrational longer than you can remain solvent. Manage your risk, use stop losses, and stay sharp. If you found this analysis valuable, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Drop a comment below and let me know what you think. Are we heading for a deeper crash, or is the bottom already in? Until next time, this is Boni signing off. Stay profitable, my friends.